Hey guys, welcome back to my channel. I'm going to hop right into things so that we can talk about all-time highs. So the S&P 500 has historically kept going up a lot, which has stimulated this meme that goes, oh, stocks only go up. Oh, all you have to do is keep betting because eventually everything's going to keep going up. And frankly, that's actually why a lot of people's 401ks has S&P 500 in it, so that basically they just keep putting money onto the market on regular intervals. And when everybody does that, yeah, I mean, if money keeps flowing into something, eventually that money pile is going to keep growing and growing. So, yeah, it's going to increase in value. But what I wanted to talk about today was actually the analysis that I did on S&P 500 daily returns. So what I did is I looked at the percent change on a daily basis. And oh, by the way, this is going to be a more technical video. I've got a bunch of graphs that I'm going to talk about. So if this isn't your thing, go ahead and click off. You can go watch something else like your memes or whatever. This is going to be more math heavy and stuff like that. So go away if you're not interested. So S&P 500 daily returns as percentages were put basically into a normal distribution because I wanted to see if they were a normal distribution. You can see somewhat they are, but then these parts on the ends start to deviate from that. This QQ plot right here, this straight line, should be completely straight if it's a perfectly normal distribution. So you can see that the outliers are really non-normal. They do some really wild things when prices jump super high or super low. This is really, really interesting to me because I expected that the daily percent return would have been a lot more positive. In other words, because the S&P 500 keeps going up, right? So then why wouldn't the returns be really positive? Well, if you zoom in a lot, what you'll see here is this green bar. I can't really zoom in more. Okay, maybe I can. Well, if you look at that green bar, what you'll see is it's not exactly at zero. It's slightly positive, just a tiny bit. So what ends up happening is if you just keep putting your money onto the market, yes, you're going to have some tiny percentage return over a long period of time. So ideally, that's going to compound into about 7 to 10% annual return on average. But that tiny little daily return, remember, it's compounding. So if you take a 7% return on a yearly basis, and if you break that up by every single trade day, it would probably be whatever this is, this tiny little percent, because that's the power of compounding. If you only get, let's say, a 1% or a 5% growth every single day, that is actually going to add up a lot. 5% compounded, it would be something like, let's do 1.05, that's 5% to the 30. So if you made 5% 30 days in a row, 30 trading days, that would basically quadruple your money. So compounding is really important as a concept to understand why this green line is so close to zero. Now, SPY daily returns over time. Again, these are the error bars for the normal distribution, your 1, 2, and 3 standard deviations. What you can see is that there seems to be a lot of movement around the recession periods or around the flash crashes. So there was the 2008 recession here, and then there was the COVID period here. And right now, we just went through an interesting phase where tech stocks went crazy. But what was interesting is that there was a bit of a lull and a pullback. So that was this little thing right here. And right here, we see this big up and down because of tariffs. So this is interesting to look at because you can see that really the most money that you'd probably make if you want to bet on volatility would be during these uncertain intervals. And that makes sense. When people are scared or feeling really greedy, they're going to do big movements. And so that's why you have these outliers where things either go really bad or really good. Yeah, and then this is just a daily returns box plot. I don't really have anything to say about this. Again, it's just showing you that there are some outliers in the positives and the negatives. I guess if you want to talk about 3 standard deviations, in one day, it would be very unlikely that S&P 500 goes up more than 4% or 5%. Very unlikely. Less than a 1% chance, it looks like, from this graph. 99% of the time, it's either going to move up or down 4% within a day. 2 standard deviations is about 90. How much percent is 2 standard deviations? I'm pretty sure it's 95%. Yeah, okay, cool. So 95% of all the movements is going to happen somewhere around, what does this look like? Maybe about 2.5. So 2.5 to, negative 2.5 to 2.5, excuse me. Approximately. And then if we want to look at this, 66% falls into 1 standard deviation. That, just eyeballing it approximately looks like 1%. So if there's a 1% movement, that's probably going to be within reason, but still significant. Anything outside of that, then you want to say, oh, whoa, what kind of news is impacting this? So that's one of the things that you might want to think about if you want to be a day trader or a swing trader, and if you want to think about movements in the market relative to S&P 500. Now, when we look at the last 3 months of the S&P 500 and we look at the volatility, we've noticed something really interesting, which is that the last 3 months is pretty non-volatile, which is crazy when you think about the tariffs. So my hypothesis for this data is that right now people are really scared and they're not interested in trying to speculate when Trump changes his mind about stuff or comes up with new ideas all the time about how to implement stuff, which can have massive impacts on the market. So when I see this low volatility, I think that this is most likely coming from fear. I think there's a lot of people like Warren Buffett who are putting their money on the sidelines and waiting until all this tariff stuff has passed. I forget who said it, but maybe it was Warren Buffett, who said that tariffs are like a modern form of warfare. They are something that are extremely impactful and potentially, I don't want to get too speculative here, but some people think that it's a lose-lose to do tariffs. Whether or not that's accurate, I guess we'll just see when the results of what's going on now come to fruition. So we look at this return distribution comparison here, and you can see that across all these intervals, it still looks relatively like a normal distribution. You have a couple of outliers here in the last year. That's the yellow parts over here. Not too much to talk about there, just generally a relatively normal distribution of the percentage changes, outlier frequency by periods. Now, this is interesting because if we look at the red has had, in the last 3 months, in other words, there have been a lot of outlier movements. And we can also see the same thing in the last 5 years, which also makes sense because we went through COVID. Now, when we look at the 3 standard deviation movements, then not really sure why the red isn't showing up there, anyway, what's interesting is there's this 2 standard deviation movement in the last 3 months of the percentage of days where there was an outlier movement on the S&P 500. Now, historical volatility is interesting here. I like this one because this one kind of shows a lot of the recessionary periods. This is the 2008 recession, housing crisis. This is COVID. And then this right here, WTF is this? This is basically tariffs, right? So that is what just happened, or what is happening right now, and that explains this level of volatility. And it makes sense when you think about it, because the pandemic was this global thing that was really crazy and nobody knew what was going on. The tariffs, yes, it was pretty much global, but now it's starting to become a little bit more specific to individual countries. Things are more stable with other larger countries. So now it's become a little bit more targeted where the volatility will happen. And then, of course, the recession was just insane. The global economy was severely impacted. This one I really like, and I really wanted to talk about. This SPY price history shows all of the all-time highs and where we have movement. So the red parts are your bull markets. Bull market here, bull market here, bull market here, bull market here. And the parts that are in between the red are the parts of downturns. So again, you have the dot-com boom here, you have the 2008 recession, you have the COVID recovery. Now, what I love about this particular graph is it kind of shows you that we're in a bull market right now. And we do have to be a little bit careful, because even though we might be in a bull market, you see all these all-time highs, all-time high, all-time high, all-time high. It just keeps going up and up and up. At the same time, we want to make sure that we're realistic about where things will go, because things won't just realistically grow exponentially. Most of the time, it's more linear. So do we see linearity here? It does look pretty linear. So it seems like it might be okay. It might correspond to inflation and, the general GDP growth. Nothing too crazy, but can you potentially use this kind of all-time high behavior to predict when the next crash might be? I don't know. Maybe that's something that I can go and investigate. Maybe if you look at how steep these curves are, you can start to understand what the impact would be in the following years. I'm not sure. If we look over here at the distribution of days between all-time highs, on average, it takes about 17 days. That's across what? About 20 years worth of data? 25 plus 8. About 30 years worth of data. Takes about 17 days. Excuse me. Now, 95% of the time, if you've reached an all-time high, you'll probably reach another all-time high within 45 days. Now, I thought that was pretty interesting, because you have all these bull market segments and stuff. And frankly, I think this kind of justifies why people, and why, you have all of these financial investors. I'm not advocating for this or trying to suggest this or anything, but there are those people out there who will say, hey, just dollar cost average into S&P 500 and then don't look at it for 30 years. That's just going to make sure that your money keeps growing over time. Because if you get scared, if you say pull out at some points, like let's say there was this dip right here and you pulled out, well, then maybe you miss out these gains. And you could argue, oh, but then look at this. It crashed a lot. It crashed over here. But even if you got in at this high price, you would still be in the money over here. You'd still be in the money over here. Truthfully, I think there's a lot of research and a lot of data that backs up the rest and put your money into S&P 500 strategy. I'll leave the discretion up to you, though, and I hope that you go and look up this information yourself or get a better idea of it by looking at the data. So last two plots, not that interesting. Nothing really much to say about those. I hope that understanding these different bull market, bear market nomenclature, in other words, understanding this red part versus the non-red part was helpful. And I really hope that you got a little bit more of a glimpse into what's going on with the S&P 500. All right, that's it for today. Thank you so much for your time. I hope to catch you in the next one. Don't forget to like and subscribe.